We're in the midst still of all these questions around trade with China. When you were on with us at the end of last year, we were talking about that, and you said, I do think that there's a need for change here. It's a pressing need for change. I hope the Chinese authorities realize this. So now, given all that's happened since then, the market rebound, are you more or less optimistic about the trajectory of these U.S.-China trade talks?
I'm slightly more optimistic, but I still believe that there are many hurdles to be cleared before the U.S. and China can declare victory on these trade talks. And I do fear that the market expectations have gone a little beyond what probably will materialize here in the next few weeks. We all would clearly like to see a postponement of a sharp increase in tariffs. Such a sharp increase would be another sharp blow to the U.S., the Chinese, and the global economy. But at the same time, I think many of us do realize that these issues between the U.S. and China, particularly the technology transfer issues, some of the other more structural problems, are going to need to be discussed over the longer term. So I hope we can see a shorter term stabilization of tariffs, short-term solution, agreement, and then the engagement in longer-term discussions.
So your expectation on what that looks like, if I'm reading you correctly, is tariffs don't go away entirely after whatever happens March 1st or post-March 1st, but maybe they don't ratchet higher and then the conversations continue. Is that right?
I think that's a realistic prospect. I believe that at the same time as we focus on the trade talks, I think it's very crucial to look at what is happening in the underlying Chinese economy, the U.S. economy, and the European economy. Of course, the trade talks do have a huge influence on global market sentiment. But I do think that as we move into the next couple of weeks, there's a reasonably good chance that we will find some temporary solutions here. I doubt seriously, however, whether this will provide a long-term resolution to these difficult structural issues between the U.S. and China.
Charles, I want to go back to a comment you just made earlier, and that's that you fear that investors at markets maybe have gotten a little ahead of themselves here in terms of these talks and the outcome. What does that mean in terms of where markets are going, at least in the near term, based on the headlines we do get? Do you think they're going lower?
Well, I think markets are going to be under a little bit of pressure, but I'm more focused on the longer term issues evolving or the more structural issues involving. And I think markets need to be focused on that as well. You know, in the private equity world, we're always focused on longer term trends. And I don't want to for a moment dismiss the importance of weak retail sales or production data, but I do think it's critical at the same time, if we're going to continue this expansion in the U.S., to look at the longer term trends, and they're not so positive right now. Europe appears to be moving into an particularly weak phase, with the German economy not far out of recession, huge issues in Southern Europe, and the data coming out of China related to the trade talks, but also somewhat independent. The data are not overly encouraging, so I think we have some structural issues ahead of us in addition to the contemporaneous issues of the data and the Fed, et cetera.
So in light of all of that, what does this mean for the U.S. dollar this year?
Good question. I've seen the dollar, as you've seen, we've all seen the dollar pick up a little bit of strength gradually over the last year. It hasn't been huge, and I wouldn't be surprised to see that trend continue, although I don't expect a surge in the dollar value against either the euro, the yen, or the Chinese yuan. I think there are various factors playing. In the European case, of course, we're looking at a weaker economy. In the Chinese case, there's a great deal of sensitivity around the exchange rate, and I think it would be unwise for the Chinese to allow the exchange rate to depreciate again substantially against the dollar. And of course, so much has to do with the position of the Fed. I think the comments by Lael Brainard and more generally the positioning of the chairman and the Fed board over the last 5 to 6 weeks since the interest rate increase in December suggests that the expectations last fall for a substantial series, a number of rises in Fed rates is simply unlikely to materialize now. This will, I think, take a little bit of the steam away from a strong dollar. Therefore, I expect to see some continued modest strengthening in the dollar as we move into the middle of the year.